Hello students, now we are going to practice how to measure the performance using this performance report with the degrees of the controllability. As you can see that this is an example of the income statement with absorption approach that does not have the variable cost or the fixed cost, but we will identify what is the variable and the fixed cost. Beyond this point, we also will identify what is the fixed cost controllable by store managers, how to give the right feedback and right reward or penalties to the store managers who has the responsibility of the result. And then fixed cost uncontrollable by store managers, also very important to segregate this fixed cost with these two controllable or uncontrollable part. So that, again, we want to give the right evaluation feedback. So let me read this part first. Let's analyze together. The Book and Game Company has two bookstores, Aunties and Merlin's. Each store has managers who have a great deal of decision authority over their store. And advertising, market research, acquisition of books, legal services, and the staff functions, however, are handled by a central office. The Book and Game Company's current accounting system allocates all costs to the store's result, as you can see it like this. But again, this is absorption approach that doesn't have the variable and fixed cost. Even there's no information related to the controllable or uncontrollable fixed cost. But here we have information there. Each bookstore manager make decisions that affects salaries and wages, supplies, and this depreciation. Oh, this depreciation is now controllable cost. You have to keep that remember. In contrast, rent and utilities are beyond the managers, that is uncontrollable or controlled by others. Because the manager did not choose the location or the size of the store. Okay, that good rationale. The supplies are variable costs. The variable salaries and wages are equal to 8% of the cost of merchandise sold. Okay, that is one of the source in order to calculate the variable cost of these salaries and wages. And then the remainder of salaries and wages is a fixed cost. Okay, so 90, the rest of the part of the salaries of wages out of this 8% of the cost of merchandise sold is the fixed cost. Okay, and then the salaries, staff cost represented cost of activities performed by the central office. So this staff cost is, right, that is unallocated cost. Events at the individual bookstore do not affect the staff cost. Okay, to be sure. Nevertheless, the Book and Game Company allocates staff cost as a proportion of sales revenue in total. So we do not allocate the staff cost $30,000 to the Aunties and Merlin's because it's not affected by this the activity events of these Aunties and Merlin's. Okay. Now requirement 1. Using the contribution approach to prepare a performance report that distinguishes the performance of each bookstore from that of the bookstore managers. Okay, again, the main point of this exercise is to identify the responsibility of the bookstore managers. Okay, so sales revenue, let's collect all this information from above. So the sales revenue, we got it. Let's drag it to the right. So it has the revenue. Then cost of goods sold, where is it? Okay, cost of goods sold is 450. So we got it. So let's drag it to the right. And then the variable cost. Okay, we are calculating variable cost. The salaries and wages, variable cost portion is 8% of the cost of merchandise sold. So we apply 8% times 8% 8% times, okay. 8% times this cost of merchandise sold. Nope. Let me calculate again. 8% times, okay. So 36,000, which is 8% of cost of merchandise sold. So we allocated each 8%. Okay. And then supplies. Where is the supplies? Okay, supplies is also the variable variable cost. Supplies, there you go, 45,000. So we allocate this 45,000 into 2 stores, which is the same amount. And then total variable cost is the sum of is 3. So 531,000, which is same as we have on. And then, okay, let's drag. So by doing this exercise, we identify the contribution margin by bookstore, which is the 700,000 minus, okay, I just want 169,000 in total as a company as a whole, and the Untitled and Marines, the bookstore has the same contribution margin. So the bookstore has the same contribution. Then fixed cost controlled by store managers. Now we have the information from above here. The salaries and wages are the fixed portion. How do you get the fixed portion? We already allocated 8% variable cost portion out of the cost of the merchandise sold. So the rest of the remainder of the salaries and the wages is a fixed cost. So we need to find this salaries and wages minus, we already allocated the variable cost here. So the remainder is 27,000. This 7,000 is the total, and then the same way, out of 30,000 total salaries and wages, we allocate 8% of the cost of merchandise sold. Merchandise sold is the salaries and wages and variable portion. So the rest of the amount is 12,000. In the same way, for the Marines. Okay, and then depreciation. The usual depreciation is the uncontrollable by stores manager, but in this case, each bookstore manager makes decisions that affect the salaries, wages, supplies, and depreciation, as you can see that. Okay, then the depreciation, we allocate this depreciation into the fixed cost controllable by store manager. So we collect all this number. And then the total controllable fixed cost, how to get it? Okay, the sum of these two. Oops. Okay, once again. Why does it show? Okay. That's the sum. Okay, let me just sum these two. Then we calculated this. Then the contribution controllable by store manager is 169, the contribution margin by bookstore, and then we need to okay, and this so that we got contribution controlled by store managers 170, so 127,000, and then let's drag it. Right. So 65,500. 65,500 is the Untitled, and the Marines is 61,000. Okay, then let's analyze this situation. Who got the result? Who got the better result? Right, the Untitled. When we just look at this operating income in total, not identifying the fixed cost controllable or uncontrollable, this total operating income result in Untis, the store, is definitely lower than this Marines. So the responsibility of this lower the operating income is for this Untis result. But when we measure the performance by a store managers, we identify that the Untis store managers did better job than Marines, because we separate the rent and utilities from the fixed cost. Okay, then let's collect this rent and the utilities. Rent and utilities is the fixed cost which is uncontrollable by the store managers. So the contribution by stores can now calculate plus the rent and utilities. Oh, wait. Okay, so contribution by bookstore 67,000. We got it. And then you see 25,500 is Untis, the contribution by bookstore, which is quite lower than these Marines. Okay, because they pay the rent and utility, which is the fixed cost uncontrollable by store managers. And then unallocated staff cost is not allocated into the stores as indicated in the question. Here, the staff cost represent the cost activity performed by central office, not by Untis. Events at the individual stores do not affect the staff cost. So here, we allocate only on the center in total 60,000. Okay, then this amount, now we have the 7,000, which is the same as 7,000 in the income statement absorption approach. But now we can identify the responsibility accounting into the two stores. It's here the Untis store, the contribution controllable by store managers and by the bookstores. First requirement, evaluate the financial performance of each stores. Then we can evaluate the financial performance of the bookstores, that is the segments of the company, using the line contribution by bookstores, here we go. Marines has substantially higher than the other, despite equal levels of sales revenue. So the books, for the perspective of the bookstore, the Marines bookstore is definitely better than Untis. But when we evaluate the store managers, these store managers of Untis is better than Marines. So because the contribution for 84,500 are the same between two stores. But the Marines managers paid 4,000 more in control of fixed cost, $4,000 more the fixed cost controllable, which is controllable, than did Untis manager. Okay, so we evaluate these two those bookstores and managers in that way. Okay, see you in the next video clip. Bye bye.